From January through early July, the US dollar saw a sharp decline, losing more than 12% of its value against a basket of developed market currencies. Now, since that time, it's entered a tight consolidation pattern and traded sideways as markets weigh a possible Fed easing cycle against a relatively strong GDP and retail sales data. But beyond the US dollar, there are some compelling moves unfolding in the currency world. So take the Australian dollar, for example. Since July, it's edged higher against the greenback, possibly reflecting the ongoing strength in gold, one of Australia's major exports. Now, in contrast, the Canadian dollar, or Loonie, is telling a different story. It's often correlated with crude oil, a key Canadian export. Yet, oil has lagged behind in the recent commodity rally. Since early July, the Loonie is down nearly 3%, possibly reflecting oil's underperformance. So looking ahead, all eyes are going to be on Canada's upcoming employment data, set for release on Friday, October 10th. Economists are forecasting a gain of 5,000 jobs, a sharp reversal from the loss of 65,000 jobs reported previously. Now, the unemployment rate is expected to tick slightly higher to 7.2% from its current level of 7.1%. So here's the concern. If the data reveals further weakness in the Canadian labor market, it could increase pressure on the Bank of Canada to cut rates again, potentially weighing further on the Loonie. So for context, the Bank of Canada cut its base rate to 2.5% on September 17th, the same day the US Fed reduced its rate to 4.125%. Now, the CME offers three different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believed the Canadian dollar was going to continue lower from here, they could express that by selling the micro Canadian dollar contract at 0.7195 and target a move to the March lows of 0.7000. Now, a stop for this trade could be placed above at 0.7310, which would be above both the 200 and the 50-day simple moving averages. Now, this trade can make $195 if the target is reached and risks $115 if you're stopped at your level. Now, if a trader believes the Canadian dollar was set to rally from here, they could express that by buying the December micro Canadian dollar contract at 0.7195 and target a move to the late July highs of 0.7410. Now, a stop for this trade can be placed below at 0.7090. Now, this trade can make $215 if the target is reached and risks $105 if stopped out at your level.